Hey, what's going on? In this video, I am going to show you everything you need to know about FHA loans. If you don't know, FHA loans are one of the most common loan programs used to purchase a home in the United States. And in this video, we're going to do a deep dive. We're going to cover everything you want to know about getting this loan program. This is going to be the most comprehensive video on YouTube on getting an FHA loan. For those of you that are new to the channel or maybe new to this video, my name's Channing. I'm a mortgage broker and I love sharing things on buying a house. I love to teach, I love to educate, and I love to give you simple strategies on how you can win. And today is FHA loans, the 2025 complete guide. Everything you need to know about FHA loans to make homeownership accessible and achievable for you in 2025. So that's what we're going to do. And what is an FHA loan? An FHA loan is a government-backed, lender-funded program designed to make homeownership more accessible. So the FHA stands for Federal Housing Administration, and they provide mortgage insurance to reduce lender risk, allowing them to offer more flexible terms to borrowers. And so what that means in a nutshell is that they're not actually lending you the money, but they are creating an insurance program that makes lenders comfortable lending you the money, even though you're not putting that 20% down, as we'll talk about a little bit later. These loans are specifically designed to expand access to home ownership for Americans who may not qualify for conventional financing. And so the FHA doesn't lend money directly. We just said that. Instead, they insure the loans made by approved lenders. And so the key point here is that FHA loans are only available for primary residents with 1 to 4 units, making them the perfect loan program for first-time home buyers and families. And so who do FHA loans help, right? Well, they can help anyone. There isn't really a limitation on who can get an FHA loan as long as they meet the requirements. But FHA loans are great programs for first-time home buyers because of some of the features we're going to talk about, like low down payments, low credit scores. So if you do have a lower credit score, FHA loans are great because it accepts borrowers with moderate or lower credit scores who you might not qualify somewhere else. Now, it's not just for bad credit, though. It's also if you have limited savings. So if you have a limited amount of money that you can put into purchasing a home, they're going to give you the option to have a low down payment, right? They're going to give you the option to have seller concessions, and they have flexible guidelines. And so they offer more lenient criteria when it comes to getting approved, especially compared to conventional loans. Now, what are the credit score requirements and the down payment requirements for FHA, right? What are the FHA loan requirements in a nutshell? Well, you need to have a 580 credit score. Qualifying for the minimum 3.5% down payment, which is a 96.5% loan to value ratio, is the most popular option, and it does require you to have that 580. If you don't have a 580 credit score, let's say you're between the credit score of 500 and 579, you could still be eligible, but you have to have a 10% down payment. So on a $200,000 home, or let's say a $250,000 home, that's $25,000. The higher down payment serves to offset the increased risk that you are because your credit is on the poor end of the spectrum. And so if you have a below 500 credit score, you're going to be ineligible for pretty much all financing, but definitely FHA financing. Now, one of the key ingredients that I want to remind you is that it's not just about your score. Now, you can Google a lot of this stuff, but this is some of the information that you can't Google. And so you want to pay attention right here. It's not just about your score. It's also about your history. And so if you have a 580 credit score, but you have a lot of late payments or even more than 1 or 2 in the last 12 months, you're probably going to have a difficult time getting an approval over someone who has a higher score. If you have those types of scores, a 580 or 600 even, and you don't have late payments, then you're going to have a little bit of an easier time. And so it's not just about your score, it's about your history, right? If you've got charged off accounts, we don't necessarily have to count those, but if you've got repossessions or judgments, like all of those things come into play. And we're going to talk more about that a little bit later in the presentation. What is FHA's debt to income ratio requirements? And so the standard guidelines, now we can exceed these, but the standard guidelines is a 31% front end ratio. That's your housing payment divided into your gross income. That's what a front end ratio is. There's 2 different ratios lenders look at. The first is your housing payment divided into your gross income. It's a 43% back end ratio. That's your total debt, including your housing payment, divided into your gross income. Again, these are starting points. They're not absolute limits. If you have good credit, if you have reserves, if you have down payment, like all these different factors come into play, then I have seen people get approved as high as 56.99% on the back end and somewhere around 45% on the front end. But those things are not guaranteed, right? And so you need to have strong compensating factors. You need to have decent credit for those to be the case. Anything, especially anything over 50%, and sometimes anything over 45%. So the other part of this, and this is just like an add-on here about your DTI, is that student loans are something that you need to consider. So if you have student loans and you're calculating your debt to income ratio, understand that even if they're in a deferment status, the lender still has to calculate a monthly minimum payment. And so student loans can significantly impact your DTI, even if you're not currently making payments. And so what FHA is going to do is they're going to take your total balance and they're going to multiply it times 0.5%. So that's half of 1% of the total student loan balances that you have across, if you have multiple loans or even one, and they're going to use that as the monthly payment for your debt to income. So if your payment exceeds, if your actual payment is more than that, or if you have a payment, let me back that up, because if you have a payment that's reporting that's more than zero on your credit report, the lender will use that. But if you don't, they're going to use this 0.5% calculation. These rules apply even if you are in deferment or even in some type of forbearance. Until they're actually forgiven, this is how the lender is going to view those things. And so if you have student loans, you want to pay attention, because this is kind of how FHA deals with them. So now it's a lot better than it used to be. So just a few years ago, we had to calculate 1% of your balances towards your debt to income ratio. But if you have student loans and you're wondering, how does FHA treat them? This is how they're going to treat them. You're going to add up the total balance. If you have, $8,000, then what is that? That's 1% is 800. So that's, it's like $40 a month, right? Something like that. So that's how FHA is going to treat your student loans. What are the employment and income requirements with FHA? Like, is there a monthly minimum income? How does it all work? So no loan program has a monthly minimum income. No one says, you have to make at least $2,000 a month to qualify for this program, or $5,000 a month. However, we go back a couple of slides, this debt to income thing, right, kind of makes it so that there is somewhat of a minimum, but it's going to be based on your market. So if you're in a market where homes cost a lot of money and you make not a lot of money, then you're going to have difficulty buying, because you're not going to be able to meet that debt to income requirement. But when it comes to your employment and your income, FHA, like every loan program, requires a 2-year work history. Now, really important to know that it doesn't mean 2 years at the same job. It just means a 2-year work history. And so if you've had a job or two or a couple over the last 2 years, that's okay, as long as you have a total of a 2-year history. Now, if you've changed jobs in the last 2 years and there was a gap of employment more than like 6 months, then you're going to have to be on your new job for a minimum of 6 months before we can use that income. But if there's been no gap and you just changed job because you got an upgrade, or maybe you finished school or whatever it is, and school also counts, by the way, as your 2-year work history. So if you've been in nursing school and now you're a nurse, that's going to be factored in. So understand that going in. If your W-2 income, meaning you're an employee of a company, then you're going to be, the 2-year work history comes into play. They're going to ask for 30 days of pay stubs. They're going to ask for your last 2 years of W-2s for any job that you had over that 2 years. If you're self-employed, they're going to ask for 2 years of tax returns. It says sometimes 1 year with strong compensating factors. I've never, maybe the guidelines technically say that. I've never seen that happen. You've got to have 2 years. Maybe if you're getting into 18, 19 months, but they're still going to want the 2 years of actual returns filed. And then sometimes they will ask for your profit and loss statements. Now, if you're self-employed, I've got an entire video on the channel of how to get a mortgage if you're self-employed. So I'd recommend you check that out. But basically you need to know this: it's your net income, right? So if you have, $400,000 a year in income, but by the time it's all said and done, you made 50 grand, it's the 50 that we're going to use, minus we'll add back in depreciation. But you just need to know that going in. Either way, whether W-2 or self-employed, consistent documentable income is the key to getting approved for an FHA loan or any mortgage for that matter. And income is the most important requirement. So of the three things that lenders look at that are kind of like the big pillars of what it takes to get approved, credit, income, and assets, the income is the most important part because you've got to be able to repay this loan that you're taking out. And so what does FHA do with, how does FHA handle collections and credit issues? So FHA is the most flexible when it comes to collections and credit issues. And so this one here, do we dive in anything else? No. Okay. So this one here is dealing with bankruptcies and foreclosures. When it comes to collections, let me just say this. Collections that are over $2,000 that are not medical will be met with a 5% of the balance calculation, similar to student loans, except it's only half of 1%. But if you have a collection and the total amount of all of your collections that aren't medical isn't counted, we'll take 5% of the balance and we'll add that as a monthly payment into your debt to income. Now, if the account is medical, we don't count it. If the account is charged off, we also don't count it. When it comes to bankruptcies, FHA says if you filed a Chapter 7 bankruptcy, 2 years from the discharge date is when you're eligible for an FHA loan. If you had a foreclosure, it's 3 years from the waiting period, from the completion of the process, not the beginning of the process. And if you've had a Chapter 13 bankruptcy, you're eligible after making 12 months of on-time payment with your bankruptcy, or if it's discharged, you're eligible as well. So that's kind of how they're dealing with some of these credit and collection issues. When it comes to assets and reserves, again, you saw earlier, we discussed this. FHA requires a minimum of a 3.5% down payment if you have 580 or higher, which is most of the people. Those funds can come from, I thought we had this in here, but those funds can come from checking accounts. Those funds can come from savings accounts. Those funds can come from vested retirement accounts and properly documented gift funds from family. Where those funds cannot come from is cash on hand, right? If you've got cash in a mattress, cash in a safe, cash in an envelope in your house, right? Those funds are not going to be able to be documented, and so we're not going to be able to use them. What you're going to have to do is deposit those funds and wait 60 plus days for them to be seasoned. So because we collect 60 days worth of bank statements, and then so that we don't have to show that deposit basically, or the funds have been in there for the last 60 days. And so that's how we deal with funds. And you need to remember that when it comes to buying a house, you don't just have a down payment, you also have closing costs. Now, seller can pay the closing cost up to 6% of the purchase price, which is usually more than enough, but that's where any funds would have to come from. Now, reserves, those are funds remaining after closing cost and down payment. So let's say it's going to cost you $10,000 to buy the house, right? That's the cash to close, or maybe 12 or maybe 14, whatever it is, right? There's going to be a portion of that with FHA. That's your down payment. You have to come up with that, right? Let's say you're buying a $200 and something thousand home. That's $7,000. You have to pay that, right? But let's say the other $7,000 is closing cost. And let's say you get the seller to pay that. Well, you have to pay you have to pay the down payment. The seller can cover the closing costs. Reserves have to be your own money. And so what a lender considers a reserve is 1 month of the mortgage payment. So if your monthly mortgage payment is $1,500 and the lender is telling you you need at least 1 month reserves to qualify, and you'll see this a lot with manual underwriting, then that means after you pay your down payment, you need to have $1,500 still left over. They're not going to ask you for that money. You're not going to have to give them that money at closing, but you do have to have it available at close, after closing, after paying all the stuff. You do have to have it available after paying everything, and it has to be your money. It cannot be gift funds. So it has to be your actual money. Now, like the other accounts, we can use your retirement accounts. We can use things like that to document and show those things. Compensating factors. Sometimes they'll also be required. Reserves or multiple months of reserves can be a compensating factor. And this will help you get approved for a higher debt to income ratio, especially if you're not an automated approval. Other things can be a minimal housing payment increase, like if your mortgage is $100 less than your rent payment right now, if you have residual income. There's all different types of compensating factors. These things don't really come into play until you have a manual underwrite. I have a whole video on my channel on FHA manual underwrites helping you understand the different requirements. Let's talk about property standards. Like, what kind of house can I buy with an FHA loan? And then what are they looking for? And so it's a primary residence only. You cannot purchase an investment property. There's a workaround, but you cannot purchase a property that you're not going to live in with an FHA loan. So that means no second homes and no investment properties. Now, if you're going to live in it, that's a different story. So because FHA allows you to purchase up to a 4-unit property, if you live in one of those units, also known as FHA house hacking, then that's a primary residence and not an investment. And so that's how people are able to get around that, because they're actually living on the property, and you have to do that for 12 months. So it's primary residence only, no vacation or investment properties, 1 to 4 unit properties allowed. It has to meet the FHA minimum property standards, which we'll talk about when we go into appraisals. It must be safe, sound, and secure. And so with FHA, they do allow special property types. So there is a process for being able to purchase a condo with FHA, though it needs to be in one of FHA's approved projects. And if it's not, it is a difficult nightmare to try to move forward with that property. So I would advise, if you know you're buying a condo, the first step would be to make sure that it's on some type of one of FHA's approved lists, or else you're probably going to need a different loan program, or you're going to need to look at a different property. Manufactured homes, also totally okay with FHA. Now, they have to meet certain foundation requirements, and as you go through the process with FHA, they will require a foundation certification before they'll close the loan. And what that's saying is that this property meets FHA standards when it comes to foundations. But you can purchase manufactured homes, and it's like 1979 or newer, right? So that's pretty cool. You can also purchase multi-unit properties. 1 to 4 units are allowed. So if you want to buy a duplex, a triplex, or a quadplex, it's allowed as long as you're going to live in one of them. And I'll tell you that the highest version of mortgage fraud that exists is people buying properties that are investment or second homes. It's all in the news right now, and they're not. They're saying they're their primary residence when they're not. So highly warn against ever doing that. But you can do FHA house hacking, where you live in one side or one of the units, and then you rent the other units out to multiple tenants. And the cool thing about that is that you can use their rent as income to qualify for the loan. So one of the really cool things that's available. Residency and occupancy rules, right? So again, it has to be a primary residence, right? This is not a negotiable factor for FHA loans. If you're not going to live on the property, you can't use an FHA loan. They want you to be moved in within 60 days, right? You've got to be moved into that property within 60 days, and you have to intend to live there for at least 1 year before you can consider it as a rental property. So just know, if you do this and you move out in 6 months and you're renting the property out, they can come after you. Now, will they? Depends on if they catch you, right? But they have the legal right to come after you, force you to convert it into investment loan. It's not a great thing. You don't want to do it. Just trust me, you don't want to do it. After the initial year, you can move out and rent the property, but you cannot purchase it upfront as a vacation home or an investment property. So whatever you're doing with FHA, you just need to go into it knowing, I'm going to live here for a year. Now, when it comes to special property types, which we kind of already touched on this, condos have to be in that FHA approved project. You can check the HUD list before making an offer. So if it's not approved, you'll know the condo is not going to qualify for FHA financing. Again, manufactured homes, they have to meet HUD standards. We talked about the inspection, have a permanent foundation, have a HUD tag, all the, those types of things. And then of course, buying the multi-unit properties is an option. And you can even use rental income from them. The caveat is you have to live in one of the units. What are the FHA loan limits? So in 2025, the FHA loan limits, the national floor is 524,225. Most of you, that's going to be your maximum. Right? In most markets in the United States, it's going to be 524,225. If you lived in a high cost area, think California, think New York City, right? Think Miami, those types of areas. The ceiling, or Hawaii, the ceiling can go up to 1.2 $1,209,750. So $1,209,750 is the maximum. This is going to be like San Francisco, New York City, the absolute highest cost areas that are out there. Loan limits will vary by county based on median home prices. Most of you that are watching me, I'm in Louisiana, it's 524, 225, right? And so higher limits apply also to 2 to 4 unit properties. So you can also borrow more if you have more units that you're applying for. Now, why does the loan limit matter? So FHA loan limits directly impact your purchasing power, and they determine whether you can use FHA financing for your desired home. So like if you're in Louisiana or Texas or Mississippi or the Gulf South where we predominantly are, you're probably not buying $1 million house with an FHA loan. It's just probably not happening. You're in jumbo loan territory, you're in conventional loan territory, or if you're a veteran, you could use a VA loan. FHA won't insure loans above your county's limit. And they help determine the maximum home price with FHA financing. They may force you to consider conventional loans if you're looking at a higher priced home than what the FHA loan limit allows. Now, you obviously could always put more down, but then at that point, it's like, why aren't we just doing a conventional? And so it will affect your home search parameters if you're in the upper limit. But if you're like a first-time home buyer, you're the average home buyer, this is not going to be a big deal for you, right? You're going to be well within the limit to be able to purchase a home. So there is a thing too, and I don't want you to get too bogged down into this because your lender is going to handle this for you, but there is this thing called a case number. And so what happens is when you apply for an FHA loan and you go under contract, the lender is going to get your FHA case number, and that case number is going to follow you and that property from start to finish. And it's connected to the loan. It's also connected to the appraisal. So one of the things that people don't know is when you do an FHA loan, and let's say you get an appraisal on a property, but you back out for some reason, that appraisal sticks with that property for like 120 days. That's really the significance of the case number. It allows the next person, if they're getting an FHA loan, they can actually use that appraisal. So let's talk about some of the costs when it comes to an FHA loan. So FHA has UFMIP, or Upfront Mortgage Insurance Premium. This is their version of PMI. And so the Upfront Mortgage Insurance Premium is a one-time charge of 1.75% of your total loan amount. Why do they charge this? Well, this is how they insure the program. So every person that gets an FHA loan, they have upfront and they have monthly. We'll talk about MIP next. And that is how they protect the program. So that is how the program never runs out of money. It's how the program continues on. Most people are going to finance this into their loan. And so that's why, if you put 3.5% down, your loan amount is higher than that because you're going to roll in this 1.75% into your loan. You can pay at closing, which would obviously reduce your loan balance. But most people that are doing FHA loans are doing it because they want to put a low amount down. So we don't see that a lot. I don't know that I've ever had anybody do that. Here's an example. On a $1,000 loan, it's $5,250, right? So you could pay it, but it'll be rolled into your loan amount if not. This amount, like I said, is typically added into your loan balance, so you'd actually borrow $305,250. In addition to the UFMIP, you also have MIP, or Annual Mortgage Insurance Premium. An annual MIP, weirdly enough, is paid monthly as part of your mortgage payment, but it's calculated based on your loan balance at an annual rate. And so the standard rate, the most common rate, is 0.55% of your current loan balance. It's annual, again, and then it's divided by 12 for your monthly payments. This is in addition to your principal, interest, taxes, and insurance, PITI, right? It's your mortgage payment. They can vary if you put bigger amounts down or if it's a streamline, but for all intents and purposes, 0.55% is it. And so because it's an annual calculation based on your loan balance, it does decrease every year. It does decrease every year. Now, maybe not by a lot, but it does decrease every year. And when your lender is quoting you your monthly payment, this is in that. So it's not like you have to add it. I'm just breaking it down for you and how it all works. And so how long do you pay this insurance on FHA? Well, if you don't put 10% down, which most people are not, then let me just say, if you do put 10% down, which most people are not, then MIP is required for 11 years if you put down 10% or more. Obviously rare with FHA loans. If you put down less than 10%, like the 3.5% that's required, then it's required for the life of the loan, which applies to most FHA borrowers. So the only real way to remove PMI on an FHA loan is to refinance to a conventional loan once you have 20% equity. Now, the cool part about that is that Obviously, conventional is on a more level playing field once you do that, because FHA, the rates are cheaper, so it usually makes the most sense to do that. And that's why many borrowers eventually refinance to a conventional loan so that they can, get rid of it. But for most people, you're talking about $80 to $100 a month. That's constantly decreasing. So it's not a huge charge. It used to be a lot. All right, I want to jump into FHA appraisals and the requirements, their purposes, and what they're designed to do. And so the FHA appraisal serves two critical functions that protect everyone involved in the transaction. It's about property value, number one, to ensure that the home is worth the purchase price. Now, this is subjective, right? Because it's the opinion of the appraiser, but it's also about safety standards. And so the FHA appraisal is also there to determine if the property meets the minimum safety requirements for an FHA loan. And so this comprehensive evaluation protects both the borrower from overpaying and the lender from financing an unsafe or overvalued property. What are they looking for? What are the FHA appraisal requirements, right? Well, the utilities need to be on. Now, this is one that we've had quite often, right? Where the appraiser goes out there, the water's off, the gas is off, the electric's off, those things are not on. And they're not able to properly inspect that property when those things are not on. So you want to make sure that you have working utilities and that everything is functioning the way that it's supposed to. They're also going to look at structural integrity. Now, they're not structural engineers, so they're mainly just looking at the roof and the overall structure to ensure that it's in good condition and it has no major defects or safety concerns. They're looking for no major safety hazards, including trip hazards, broken windows, missing handrails on stairs, exposed electrical wiring is another, and paint condition. They don't want any peeling paint or chipping paint, especially if that home was built before 1978, because they were using lead-based paint back then. So that's what they're looking for on that FHA appraisal. Now let's talk about some common FHA appraisal issues. It's all the ones we just talked about, right? Chipping or peeling paint, they will make you paint it before they let you close the loan. So you want to make sure those things are dealt with. HVAC, especially heating more than cooling. They want to make sure that the heat is working, that it's properly ventilated, that all of the air conditioning systems, water heaters, that they're all functioning the way they're supposed to. They're making sure they're checking for roof issues, that there's no leaks, that there's no missing shingles, and that the roof is not overall just in poor condition that could lead to water damage or safety concern. If the appliances are missing, that can also be a problem, especially a stove. So the stove is the most important one. They want to make sure that the property has a stove and that it's able to be used and that it's functional and working. And then sometimes also well and septic comes into play in rural properties, especially. They must meet the specific distance requirements from the Health and Safety Board, right? So they're gonna check on those things as well. So that is the FHA appraisal requirements and some of the common issues. I hope that's helpful to you. What are the benefits of this loan program, right? Here we've been talking about it. Why should you consider it? Well, one, the benefits of an FHA loan are that they have a low down payment, right? 3.5% down makes homeownership so much more accessible to buyers compared to conventional loans, which will require between 5 and 20%. Now, 5% is always the minimum requirement, even if you're not a first-time home buyer. But what happens is you have to have really good credit to qualify for that. So if you have a lower credit score, they may not give us an automated approval until you put 10 or 20% down. So with FHA, that's less of a factor, right? The other thing about FHA, they're way more lenient on their credit requirements. So they'll allow for things like collections and not require you to pay them off. Whereas with conventional, if you've got collections, they're probably going to ask you to pay them off, right? They're going to give you higher debt to income. Like I said, you can go up to 56.99 if you've got good credit. Whereas conventional, it's 40, it's 50%. It's anything under 50%. They're just more flexible. And then gift funds are allowed on pretty much every loan program. So notwithstanding, FHA also allows it. Down payment and closing costs can come from family, making gift funds, making it easier for first-time home buyers, right? The other thing, it's not mentioned here, but I want to say it, is that FHA allows the seller to cover up to 6% of the purchase price back to you for closing costs. Now, your closing costs are typically going to range between 2 to 5%. So you're able to get pretty much all of your closing costs covered by the seller, which is great, especially in a market like I am in right now in 2025, where rates are a little bit elevated. There's not as many buyers. And so it's a lot easier to get those seller concessions unless you're in like a really, really hot market. One of the other things about FHA, also great in a higher rate market, is streamline refinancing. So future FHA streamline refinance option allows you to take advantage of rate drops with minimal documentation. So you don't need to order a new appraisal. You don't need to provide any of the documentation typically required around that. And you're still able to do a refinance and get that lower rate. Now it says assumable loans here. FHA loans are assumable, but future buyers, that's allowing future buyers to take over your payments. I don't see this getting approved a lot, y'all. So we're just going to move past that. FHA loan limitations, right? So what are the downsides? We're talking pros and cons of FHA loans. What are the downsides to consider? Lifetime mortgage insurance. It's the biggest one, right? For most borrowers who put down 3.5%, the MIP is going to last for the life of the loan, right? So you're going to have to refinance it to get out of the PMI. Now, like I said, versus having to put 20% down, versus having to pay the higher rate on conventional, it still far outweighs, but it is a con over time that you'll want to maybe look into a refinance as you build that equity. The other thing is they can be more strict on property condition. And so they will have stricter property standards, or they can delay or completely block deals because they don't meet FHA's requirements, especially if the seller is unwilling to fix them or remedy them. Now, the loan limit restrictions are another one. If you know you're buying $1 million property and you're not in a high price market, FHA is not your loan, right? If you're going to be maxed out, FHA is not your loan. You're going to want to look at conventional, or if it's high enough, you may even be looking at jumbo, and that's typically over $1 million. So, or whatever, over the county loan limit. So it's almost $1 million or along those lines right now. And then of course, primary residence only. However, if you're going to live in a multi-unit property, you can make it an investment. You just have to stay there for 12 months. So that is the pros and cons of the FHA loan and why you should potentially get one and why you should potentially not. I want to talk about now how to apply for an FHA loan. And so it's not really any different than any other loan program. One is you want to gather your required documents. You're going to look for your W-2s. You're going to get your 30 days of pay stubs. You're going to get your 2 months of bank statements, get your 2 years of tax returns, especially if you're self-employed, and a government issued ID. And by having all that ready, when you do the next step, which is making an application with a lender, it's going to make that part of the process a lot easier. And then you want to find an FHA approved lender. Now, in 2025, I don't think any mortgage lender is not approved to do FHA loans. So, here at Bayou Mortgage, we do them. We can help you with them. Not all lenders offer FHA loans. I guess technically not, but most do. But you do want to research and compare multiple FHA approved lenders, because if you watched one of my videos where I talked about how mortgage rates work, when you don't work with a mortgage broker on FHA, the retail lenders can charge you whatever they want. And so they'll often be a lot more expensive. So that's just some food for thought there. And then number 3, getting pre-approved. So you want to obtain a pre-approval letter that shows your maximum purchase price and estimated monthly payment. If you're not sure what goes into a pre-approval, I've got probably 5 videos on the channel where I walk through that. Go check that out as well. It will strengthen your offer. And so the first 3 steps establish your foundation and buying power before you start house hunting. Steps 4 through 7, shop for your home, right? You've got this pre-approval letter. Now you can take it to your real estate agent, find properties within your budget that meet the guidelines, and then you can move into, once you go under contract, the FHA appraisal and underwriting process. So the appraiser is going to go out, do all those things we talked about on appraisals, and then you're also going to go to the underwriter. And so the underwriter's job is to look at your loan application, look at all your documents, and determine, does this person meet the requirements? A lot of times in this part of the process, there's some back and forth with the underwriter. They're asking you for a document here or a document there, and you're having to provide that so that we can move your loan forward. So once you're under contract, your lender orders the FHA appraisal and begins that process. Then we move into the back and forth where we satisfy those conditions, right? It's addressing any of the conditions from the underwriter, which typically look like additional documents, completing any required repairs. Now, you as the buyer don't do that. Those are the seller's responsibility, but they can say no. And at that point, the deal would kind of just move along. And they would also provide any additional documentation as needed. Once all that's done, appraisal's in, title work's in, you've satisfied all conditions. it's time to move in, right? You get the clear to close, you schedule a closing date, you go down to the title company or they come to you, you sign your documents, you get your keys, and you move into your home. And you need to do it within 60 days. What's the timeline of an FHA loan? So the standard timeline for an FHA loan, most lenders are going to be able to close that loan between 30 and 45 days from contract to closing. That's typical, right? We try to do them within 21 as a broker, and they could go as fast as 15. But that the timeline, it fluctuates because banks and other types of lenders, credit unions, things like that, will often take longer. And so it kind of increases that average timeline overall. It could literally be anywhere from 14 to 45 days, but 30 right there in the middle or less is what we tell our clients and what we aim for. Obviously, there could be potential delays, and things that would make this take longer is if there are repairs required and it takes them a while to get those repairs done. If you're trying to get the condo approved, then just buckle up. It's going to be a minute. We wouldn't even recommend trying that. And then obviously there's some back and forth with underwriting conditions, but it shouldn't create a delay, right? Those things should be getting vetted out up front. It really comes down to the repairs or any type of an appraisal issue. So you just want to be prepared for that going into it. That's kind of the expectations for that. Let's talk about some practical tips for getting an FHA loan, right? Think about the MIP, know what you're getting yourself into. Again, when your lender quotes you, your payment, it's built in, so you don't have to go add it on top of that. So that's one. I think a big one is in your mind, now that you kind of know what FHA appraisers are looking for, as you're touring properties and you see that there's 2 steps, but there's no handrail, or there's a deck on the front of the house that's more than 2 steps, but there's no handrail, right? There's exposed electrical wires. Like, think about those things as you're looking at the house and go, I know they're gonna call those things out. So we need to figure out how we're gonna get those fixed, right? If you're getting gift funds, you've got to get with your donor ahead of time and let them know that they can't just give you the money, that there's a letter that has to be signed by all parties, and they have to document that money either by showing that money leaving their account via one of their bank statements, which they can be cranky about, or they can deliver those funds directly to the title company to waive that requirement. The other thing is you want to think about if you're going to need seller concessions or not. I recommend every buyer ask for them because it saves you a ton of and allows you to keep so much more money in your pocket. So it's 6% towards those closing costs. That's what FHA is going to allow you to do. And then the biggest tip, whether you get an FHA loan or any other loan, be responsive with your lender. Don't delay in getting documents. Don't drag your feet, because all you're doing is extending the amount of time that it's going to take for you to actually move in. So what are the key takeaways, right, from this video? You've joined me this far. Thank you so much. FHA loans provide an easier path to owning a house because of the flexibilities that it offers. 3.5% down, credit scores as low as 580, enables lower down payments because of the PMI. The property does need to meet higher standards, and it is primary residence only. Those are the essentials, right? What's your next step? Well, you want to check your credit score and your DTI. You want to verify the FHA loan limit in your area. You want to gather up that required documentation, shop for a mortgage, get pre-approved, and start house hunting. That's what you want to do, right? Understanding the complete process. This is helpful for some people. You have the preparation phase. That's where you probably are now. That's probably why you're watching this video. There's the application phase. Listen, if you do want to get pre-approved, you can go to workwithchanning.com. That link is in the description. We can actually help you with this. So we can do pretty much all of this process for you except doing the app and gathering your documents. You got to do that, right? Then you enter into this contract phase where you're making offers and you're going under contract. If you're not pre-approved, this is where you want to get to. You want to get to where you have the ability to shop for homes. So you got to tackle the first 2 phases. And then you enter into that 4th phase where you're able to complete everything and close on that home. So your path to ownership starts now, right? You've watched this video. FHA loans have helped millions of Americans just like you buy their own home. With 3.5% down and flexible qualification requirements, it's probably closer than you think. And so you can take action today by going to workwithchanning.com. You can book a call and I can help you get prepared. Also, I've put together a complete FHA guide that's also going to be linked to in the description, where it covers all of these things that we talked about, but it's in a guide format that you can go back and reference to. So you want to get that expert guidance by checking out our guide, by booking a call with me, and then let us take over from there and help you, work alongside you and guide you with this part of the process. Again, that is workwithchanning.com. If you go there, we'll be able to get you set up with a call, get you set up and ready to rock and roll with an FHA loan or whatever loan, right? We can look at all sorts of different types of programs. Workwithchanning.com. Thanks so much for checking out this video. I'll see you on the next one.